Magnus and I have been friends for a long time. I've watched his career with great awe. He moved out of financial journalism into starting Brenthurst after another company that he started was absorbed, and he's had his trials, he's had his challenges. He's come through them because he has a view of the world which is one that is shared by many of those who have been presenting here the past couple of days, and that is, there is nothing more powerful than the truth. Over to you, Magnus.
Look, thank you very much. And I thank you for asking me to come and talk here today. My talk is about investment advice in abnormal times. And we've heard more often than not yesterday, today, and you all know that we're living in abnormal times in South Africa for most middle class, upper class people who are trying to build wealth, acquire wealth, preserve wealth. It's not a normal society that we're living in. And that's the theme of my talk, that as investment advisors, our advisors at Brenthurst, and we have, by the way, 23 CFPs in the practice. We've now got 10 offices countrywide. And, we try and give advice that suits the ultimate objectives of their clients. And I need to draw a distinction here between asset managers or fund managers and financial advisors. There are two different groupings in law, in regulation, and in practice. And a lot of people don't fully understand this. When they often hear a fund manager get up onto a podium or write an article, and the advisor is very bullish on a certain fund or a sector or whatever, they need to remember that is not advice. By regulation. There should be a disclaimer under every single article or pronouncement. And most fund managers stick to it, but with the influence of the asset management industry in South Africa, that message sometimes gets blurred, and it confuses people when they come to us and say, but that guy's saying we should do this. And we say, that guy's not an advisor. He's not qualified to give advice. He's qualified to run his funds. That's the one context. Your slogan has the word context in it. Very important to remember. And a fund advisor, asset manager, may not give you advice unless they're registered, and they're not. They are qualified to run money. Advisors, on the other hand, operate under a very strict regime of responsible advice, and the outcomes is very important of that advice. And that's our ethos of our business. We need to give advice which tries best to provide the best outcome for our clients, and there's a balance between risk and return. And those are the two concepts, the two poles that we've been giving advice to in the last 10 to 15 years. Prior to that, it was quite easy. And again, one needs to understand the context. I was glancing through the annual book that Credit Suisse brings out. They call it The Triumph of the Optimist, and they calculate the investment returns of all major stock markets, including the JSE, going back to 1900. Now, who was around in that year? I don't think many of you, but the stats go back to 1900, believe it or not, and they calculate the running returns of the most major companies, including South Africa. Well, the top three performing countries from 1900 to 1980 was the United States, Australia, and South Africa. They almost were, as they say in Afrikaans, kop aan kop, annual returns over time, 9.5% to 10%, compounding in dollar terms year after year. So there's no question that the JSE, during that period of time, with the two world wars, with its boom in gold, diamond, chrome, manganese, platinum, was a fantastic place to be. 1980, when Alec and I were financial journalists, we could buy $1, with R1, we could buy $1.40. So we would give them a rand, and they would give us back $1.4. One of the strongest currencies in the world. The South Africans were well-traveled. They traveled the world. They were known as the biggest spenders in Europe, in London, America, and that was the However, and this is where the context comes in, from 1940 to today, things changed very dramatically. The 80s and the 90s were not good periods of time for the JSE. In fact, it underperformed quite badly until about the year 2002, when we had two things that happened. First of all, we had China joining the World Trade Organization, and the demand for commodities went through the roof. So 23, 24, 25, 26, 27 were absolutely money-making years for asset managers, for investors. We had compound returns of 30, 40% was fairly common. We were in that market with value funds. Piet Viljoen would like to hear about that. We were stuck into John Bickard's value funds. We made enormous amounts of money for our clients because that's what the facts were telling us. We had the construction boom in South Africa in preparation for the World Cup 2010. And the residential property market was booming hand over fist. You can go look at the F&B stats. I looked the other day. Property prices were going up in South Africa from 2003 to 2008 at 25 to 35% year after year. Believe it or not, 2008, great financial crash, changed the rules, changed everything, and we had the big crash. And ever since then, South Africa has been in a little bit of a decline. And this is just a stat I get from a friend of mine. He did it for me this week. Claude Baysock, he's an economist making a name for himself. The black line is, of course, the GDP growth of South Africa. You can see there how the economy boomed the earlier 2000s. 2007 was the peak. It was a peak in many respects for capital formation, for revenue generation. Our GDP, our budget deficit was 20% of GDP. I mean, it was fantastic. Ever since then, it's been on a long, slow decline. The yellow line is the projections done by the Treasury of South Africa on their growth forecasts. And the point is that they're generally over-optimistic when it comes to their forecasts, which has an impact on revenue generation, capital growth, unemployment or employment. So again, the risk is very high that they can overshoot their projections, which happened last week. And already economists and the Financial Mail and other commentators are saying, hopefully over-optimistic, which is going to have an impact on a lot of things. The net result is, of course, that the performance, and this is just, I took this just to lighten the mood a little bit, but the South African economy is in ICU. It's no question about it. It's trundling along at 1.5%, 3% GDP. I mean, it's been that way for a long time. In fact, in many sectors, our GDP per capita is now down 20 or 30% from 30 years ago. And we see it in many ways. We see it in personal wealth per capita. We see it in housing, in construction, etc. It's making us, as a country, as a whole, very poor. These are the facts that you cannot deny. This has had an impact on the investment returns that people have been getting on the JSE and produced by the JSE. And because I can only use 6 charts, I could have taken the 15-year chart, which started in 2008. It shows you that the JSE has been one of the worst performing markets over that period of time. When you compare it to the Nasdaq, which is perhaps unfair, but the S&P 500, the Dow, the MSCI World, even emerging markets, we were an extremely poor laggard, your return. So that's the 10-year number. I've just, for the sake of summation, the Nasdaq gave you 26% per annum in rand terms, the S&P 20.9, MSCI World 17.8, and the Satrix that gives us the ALSI just over 10%. Most equity funds gave you a lower return, but that shows you how poorly the returns have been for South African investors. And you can continue 5 years even, which includes the big volatile movements the last 3 years with markets crashing, markets going up, markets crashing, COVID, Russian invasion, etc. Nasdaq's still the best performing sector. S&P 500 second, MSCI World 17, and then Satrix ALSI at 9. That's the 5-year number. CityWire, one of the publications that I follow, last week published an article which was quite surprising. They tend to shy away from these comparative analyses. Shows that the last 5 years, only 9 funds in South Africa managed to beat inflation, and 3 of them were linked to commodities or pure commodity funds, including Pitfall Fund. 6 were enhanced income funds. The rest did not beat inflation after costs and fees. And I'm quite sure you've never heard these facts, but this is quite surprising. So, and you can extrapolate that underreporting to most pension funds in this country. They've not made a cent in real terms in 5 years, 7 years. Some funds that I've picked up, very large insurance-based funds, have not beaten inflation in 10 years. They've actually been putting in money, they're getting back less. I found a fund, I'm not going to name the fund, their annual management fees over 7 years were higher than the returns that they gave back to investors. So it's been a dreadful period for investors in the South African stock market, either via pension funds, indirectly provident funds, and directly in stock market portfolios linked to the index. It's been a terrible period of time. Then we can even look at the 5-year period of time. The same story. This includes COVID, and it includes the Russian invasion. Bearing in mind that period was characterized by a massive boost in commodities prices. We had another commodity boom, a mini commodity boom, and you can see it in Pitt's fund and other commodity funds. So the returns over the last 3 years have been boosted by commodities and 1 or 2 big dual-listed stocks that carried us through, Naspers, Prosus, Richemont, etc. But despite that massive boom in commodities, we could not beat the 3 or 4 major indices that I follow to look at investment performance. You will find very little media and market commentary on this, and the reasons are very clear. We don't come out very well. This would not convince any of you to put money in this local stock market if you see these numbers. And even on 1 year, I was very surprised that we could not beat the JSE versus the world, the MSCI world. The world as an investable place has beaten both the S&P 500, Satrix, and Nasdaq. Of course, Nasdaq had a humongous crash, dropping 30 to 40% beginning of last year. So it was a very bad time for technology stocks, but not far off the pace. So I'm trying to summarize that it has not been a great period for South African-based investors. At the same time, you also have the other pot of wealth, property in South Africa, with the exception of the Western Cape, has not been a great area to create wealth. And we see a lot of clients, we almost like a confessional in a church. The people come and tell us about their investments. And when we start analyzing funds and returns, etc., we realize without foreign exposure, these people have become very poor. Middle class, the last 10 to 15 years, without a significant offshore exposure, has become very, very poor. In some instances, they move up from upper middle class to middle class based on the returns of their South African-based assets. Remember, ladies and gentlemen, we only get, as independent financial advisors, I need to put the context again. In South Africa, you've got broadly 2 categories of investment advisors. Those that are licensed to give advice to their clients. One is the tied agency force, and they're by far the dominant. They work for the large companies, the Liberties, the Old Mutuals, the Sanlam. They may only give advice pertaining to those funds of the company. So don't expect independent advice. You will get what they have to sell you. The second category of advisors would be the independent financial advisors who can take from the best of the market. They can choose their best fund managers. And of course, I would advise you to deal with an independent person. But the point I'm trying to make is both these categories, unless there are certain incentives that I'm not aware of, I know Bruce Cameron always spoke about perverse incentives, and I suspect they are quite prevalent still. The only source of fees, compensation for independent financial advisors is the client. The client pays for everything. He pays for the advice, the management, the the paperwork, the regulatory issues. The fees come from the client, nowhere else. And a lot of clients sometimes don't fully understand it. They think we get paid by a fund manager. Not the case. Not the case. In terms of the regulations, you get paid by the client. So that's why it is so important to do independent analysis, to be independent thinking about what is happening in the South African context, the fears, the risks that we are facing, and also what is happening in South Africa at the moment. In the marketplace that we operate in, it's the upper middle class. There are a couple of issues. Now, can I or our company recommend local investments based on past historical returns? I think not. But there's an added dimension with what's happening with the massive, let's call it, demand for people wanting to externalize themselves, their families, their children. You have to advise appropriately to build offshore nest eggs for that to eventually happen. And we've seen research by France Cronier's research foundation saying 50% of property, professionals in this country, including accountants, doctors, veterinary surgeons, etc., are contemplating immigration in the next 3 to 5 to 7 years, depending on what happens in South Africa. So we cannot advise them to build a local nest egg, and if they're going to be moving offshore, because you expose them to a massive currency risk. So that's why when we get criticized, or myself, that I'm disloyal to the country and anti-this and negative and all that, I'm saying, well, first of all, you don't pay me. My client pays me. I have not had one blowback from a client over the last 5 to 10 years who had a go at me for taking their money offshore. In fact, we get thanked by people to say, thank you. You saw stuff we didn't see or didn't believe how bad it is. I'll give you one example of it, 1 minute. MD of a listed company came to see me 6 years ago, 5 years ago. It was the biggest preservation fund I had ever seen. It was 51 million rand. And we spoke about objectives and risk and return. And eventually my advice to him was, take your money out of the preservation fund, pay your tax, which was 17 million rand, and let's get your money offshore, because he was going to end up offshore one day. Well, we did that. We paid the tax. He was white for a week, but then he felt better because the market went up. We externalized those assets, 34 million rand. Get a phone call from him the other day. He says, I now have 62 million rand offshore. It's 100% out of the country. And by the way, I'm now going to work in Germany. And that's what I'm talking about, taking all these factors into consideration. So I would like to end up with saying, my advice, or the advice of our company, is based on facts, our own analysis of the political situation. Ellen Zilla spoke about it last night, what could happen in the election next year. And she said, to quote her words, an ANC-EFF coalition is the worst possible outcome for South Africa. Tim Cohen from the Daily Maverick this morning wrote in Daily Maverick, he says that's precisely what's going to happen based on what's happening in the local municipality. So there's a very high probability that there's an ANC-EFF coalition. Now we have to try and analyze, what does it mean for your money? Bearing in mind, the EFF many times said that when they get into power, they're going to close this foreign investment allowance, because it's still just a regulation that has been relaxed. So that you need to take into consideration when you do your own financial planning. Peter Bruce from the Financial Man exactly speaks about the same thing this morning, that this regulation is still in place, despite the fact that it's been relaxed. So that, ladies and gentlemen, is a summation of a very bigger problem. The advice has been correct. The returns offshore have been better. And considering what's happening in this country as an objective commentator, trying to understand the long-term, medium-term objectives of our client, for the time being, as far as equity investments are concerned, I need to stress, our bond returns, our enhanced income returns have been phenomenal. We need to consider taking that money offshore, externalizing it, building offshore nest eggs. If we're wrong, we bring it back. But you can't do that if you're wrong and you leave all your money in South Africa. So that, in short, ladies and gentlemen, is my brutal message to you this morning. Thank you.